Your portfolio at the end of the day is still an investment. It needs to grow over time. But if you ignore taxes, you could lose out on a decent amount of your returns.
Right.
So just be smart. You know, on this episode of Off the Wall,
Right.
what we're really focusing on is how to build a tax-efficient portfolio, which I know is everyone's most riveting topic that they can think of.
Exactly. Right. And I really don't want to talk about college basketball, nor the University of South Carolina Gamecocks with their college basketball team. Although the Lady Gamecocks, they're doing really well. But anyway, that's not what we're here to talk about. We're here to talk about how to build a tax-efficient portfolio.
Right.
Which is super exciting.
Oh, it's so exciting. I can't contain myself. I'm just going to keep interrupting you about it. But I think when you think about it, it's already too late for 2025. You've missed the boat. For 2025, making changes now is not going to help the picture that you're going to have to file in a couple months.
You got the bill coming in April, baby.
No matter what you did.
Maybe October.
Yeah. It depends. Hopefully not. Honestly, I just pay your taxes, get on with it. But I understand complexity, blah, blah, blah. So what are we talking about is what can you actually do to make your life better in the future?
Right.
Take
so 1 year from today, what will you have done that makes you feel good that you did it?
Correct.
How's that for good English?
Well, and
right.
If you don't listen to us now, listen to this episode again in a year.
Right, exactly.
Because it's going to change a little bit. Tax code changes, but when you think about how to build a portfolio, there's only so many things that you can do.
Right.
We're going to use a lot of cliches because that's just what taxes are. Taxes are unavoidable. Death and taxes are the two things in life that are guaranteed. When you look at it, though, there's ways that you can structure your portfolio just to help make it more efficient.
Right.
So not avoid taxes, maybe, because again, you never really want to avoid taxes because that means you didn't make money. Taxes are a first world problem, however you want to phrase it. If you're paying taxes, you made money.
Right.
Good for you. Just kind of maybe be efficient with it is how we're talking about it.
It's also a mental accounting game, right? And I'll use two examples. So most people who have a W-2 income, they get a paycheck, the taxes come out of it before it ever hits their bank account. So from a mental accounting perspective, they get what they get. The exact opposite is true with a portfolio because you look at it, you're like, I've got $1 million in my portfolio. No, you don't. Okay. Because the government owns some portion of that the gains in the portfolio. So it's a mental accounting game because you see it in there and think it's yours, but it's not in the investment accounts.
Yep.
But with your paycheck, you're like, oh, the money's already coming out. You don't feel it. You don't think about it because what ends up in your checking account ends up in your checking account. So that's what I think makes it so difficult to talk about taxes from an investing in a portfolio perspective is people have that, I've got $1 million or whatever they've got.
Yeah.
And you don't.
Well, and it creates a lot of bad decisions, honestly, around that because of that bias that you have on there.
Right.
And so, again, by taking some of the steps that we're just going to talk about here, you can really make it easier on your brain and your portfolio.
Right.
You'll save money, you'll pay less. So, and I think a good place to start is we're only really going to talk about taxable accounts here. So your Roth IRAs, your IRAs, those have tax implications.
But down the road.
Correct.
Right.
Or you either pay the money, you pay the tax when you put the money in the account, or you pay it when you take it out of the account. But that lets you trade within the account without any tax impacts.
Right.
There you go. That's all the retirement account tax conversation we have to have. When you think about your taxable account, which for a lot of people does become their largest portfolio, especially if you go through a liquidity event, selling your business. That's usually taxable money that's coming your way. And you have to figure out how you're going to invest it to be efficient with it. So when you think about just taxable accounts, I think the place that I want to start is people always like to think about the income being generated by a portfolio. When you think about the income that's being generated, how can you be efficient with it is always the question I think that we look at. Because a lot of the time, that income that you're generating from your portfolio is taxed if it's like a paycheck, which can be really high rates, especially for high earners.
Right.
So how do you kind of structure your portfolio or think about different investments to include in your taxable portfolio to maybe lessen that burden?
Right.
I think the obvious one is municipal bonds. Ready? Now we talked about taxes. Let's talk about another sexy topic.
Right. Because listen, nothing will set the internet on fire faster than a conversation about municipal bonds.
You ready? I will set the internet on fire.
All right, let's go.
So here's what it is. There are huge benefits from a tax perspective for municipal bonds and taxable accounts.
Yeah.
Because all municipal bonds, federally tax exempt. So any income that you're collecting from these municipal bonds, you don't have to pay federal income tax on. That's a huge win right there.
Right.
Now you get to double dip though. You can only double dip if you're buying a municipal bond from the state you're a resident in. So, a lot of people we work with here in the DMV area, Virginia is a big one, just given we're in Alexandria.
It's about to be bigger.
And if you, it really is.
Recording,
Right.
January of 26. Let's see what happens. See if state income tax rates go up to 13% or not.
And imagine if you could avoid that.
I know. I mean, listen, people are going to be really interested in Virginia's municipal bonds.
Yeah, because if you buy the bond from the state that you're a resident of, you get all that.
On that either.
You get double dipped. No tax, state or federal.
Right.
And I live in New York. Guess what else? That's a huge benefit to high tax states is by investing in those kind of things. So when people think about it, they see usually municipal bonds have a lower yield, so they pay less than a corporate bond. So what do people do? Well, why would I buy the one that only pays 3% if I go get something that pays 7%? Well, because when you factor in the after-tax returns, you're going to get taxed on all that income from that corporate bond.
Yep.
The municipal bond, you might be flying free with no taxes.
Right.
So at the end of the day, do you really care about how much it pays you? Or do you care about what you get to keep?
And you should care about what you keep. Right.
Right.
And I don't want to overcomplicate it, but there is some math involved because in certain instances, even after you pay tax on certain bonds, you can walk away with more money. That's not an official finance term, right? My favorite finance professor, Greg Niehaus down at the University of South Carolina, I think he's still there. He probably wouldn't like me saying it that way, but that's how you have to think of it, right?
Well, and finance likes to make things more complex than they need to. Let's not lie here. They love to do a Wizard of Oz a little bit on you, but that's what I like talking about it, is because you can really bottom line it like that.
Right. We're not going to talk about ossified portfolios. No, well, maybe a little bit we could later on.
We'll see how
that's easier, right?
But I think, again, when you think about it, to your point, it doesn't mean you have to buy all municipal bonds or should.
Right.
But you need to be able to do the math or at least think about it critically. Understand the trade-offs. Well, that's when we're building bond portfolios for clients and taxable accounts. That's what we're focusing on. And to use the nerdy finance term, it's tax equivalent yield, aka what are you actually going to take home? And
After
that's what matters.
taxes.
And that's what matters to clients when they were thinking about the income that a portfolio can generate.
Right. I'll tell you the other thing that makes municipal bonds difficult for people to process mentally is that the value of them changes on your account statement.
Yeah.
Based on a lot of things, but I'm just going to say interest rates, because most people know that when interest rates go up, the price of a bond goes down, and when interest rates go down, the value and price of a bond goes up. Okay, so if you're in an environment where interest rates are going up, the value of your bond on paper, on your statement, could look like it's losing money. But if you're holding those bonds to maturity and just, as they say in the industry, clipping the coupons, meaning just cashing the interest payments you're getting, right? And you hold that bond to maturity, unless it defaults, you are going to get par value. So you know definitively what that bond will be worth so long as it doesn't default.
Yep.
So municipal bond investors should probably enter into the purchase decision and the portfolio construction decision process of saying, I'm going to buy this and hold it to maturity, and I am not going to care how much it shows it's worth on paper because I'm not selling it.
Exactly. And I think that's a great segue into kind of when you think about the other ways you can do tax efficient, or what you need to be aware of if you want to be tax efficient in your portfolio, are unrealized gains and losses. So what you just talked about there is bonds can show on paper that it has a loss. They say that it's an unrealized loss, meaning you're carrying it in your portfolio. To your point, if you're a bond investor, you bought the bond because you were comfortable with it up front. So unless something has drastically changed, you're planning to hold it to maturity. That all doesn't mean anything. With stocks, the same kind of thing can happen, but it's a little bit different because there's much more risk, right? You haven't locked anything in.
And there's no maturity date.
No maturity date. The stock can go on in perpetuity. So when a stock rises in price, you have an unrealized gain in your portfolio. I think that is where clients, maybe to your point, they see their account value as $1 million. But if you have a $250,000 unrealized gain, you've made a lot of money, but eventually you're going to have to pay taxes on that if you sold your whole portfolio.
Right.
Not on the $1 million, on the amount of money you made. And those sometimes, depending on how they're treated, can be taxed at very different rates.
Right.
I think that's always something to be very aware of, especially for very high income earners. So we talked about bonds, the income there, municipals, the benefits. Well, if you're an equity investor, looking at how long you've held an investment can be very important to the tax picture. Mm-hmm. So I'll give you an example. Say it's the 31st, December 31st, you buy Apple stock. Over the next year, it goes up 10%. So you have a 10% gain.
Mm-hmm.
If you sell that stock within a year, that's taxed at your ordinary income levels.
Right. Which is, if you're a high income earner, it could be in the 40s.
It is insane sometimes how much you can give up in a portfolio's return if you only have a short-term gain. Now, here's the caveat. If you hold it for 1 year and 1 day, so again, I bought it on the 31st. If I wait a full year and buy it and sell it on the 2nd of the next year, market holiday on New Year's, because, we get some days off, thank God.
Right.
That's now taxed as a long-term capital gain. And those rates max out at 20% for the highest earners. So you think about that. You can either pay 40% on an investment if you held it less than a year. If you hold it over a year, you pay half that in taxes. Now, here's the big thing I think a lot of people try and think about is, well, I only want long-term gains then. Okay, that's a great idea in theory. But if you have a crappy investment, is it really worth holding on to a crappy investment just to maybe save some money on taxes?
Right.
I don't know. I wouldn't do that. Not at all. Because I wouldn't want to lose all that value. Again, I want gains. So now there's times where it does make sense. Let's say you decide to sell a stock 3-5 days before it matures into a long-term gain. Might be worth just kind of, saying, I'm going to sit on my hands, be smart in a tax efficient way. Other times, you might not have that ability to wait. But just like we were talking about with tax equivalent yields, it's all part of the big equation. Is not how do you avoid taxes, but be efficient. So it's knowing the difference between long-term, short-term gains can add, I think, a big value to your portfolio overall.
Mm-hmm.
Now we get to talk about losses, right? Everyone loves to talk about losses.
Well, actually, I do like to talk about losses because I think they're the silver lining, right? They're the silver lining of a portfolio that's going through some volatility, right? Because I like to say with losses, if you can frame it in your own mind as, okay, I bought $100,000 worth of portfolio and the market just went down 20%. So now my $100,000 is worth $80,000, right? Mm-hmm. People will tend to say, I don't want to sell anything at a loss. I'll sell it when it comes back, right?
I hate that.
Oh, I do too, because it's not the right way to think about it. Now, if what you're holding that went down 20% still has great long-term prospects, good earnings, and is just sold off because there's more sellers than buyers, that's one thing. But if you're holding on to losses because the company has changed tactics, earnings have gone down, something's happened in the company, it's being poorly managed, whatever it is, you've got to ask yourself, what are the chances of that already hammered company because of its poor performance? Mm-hmm. What are the chances of it coming back to what you paid for it at versus selling it, getting into something else that does have a higher chance of making money back? Now, the silver lining there is that when you buy, so let's say you sell stock A because it's not, it's had a problem and the chance of it coming back are low. You buy stock B, it goes back up in value. You can take those losses that you had in that stock and carry it forward indefinitely. So at some point when you do sell stock B, you'll get to at least chip away at some of those gains and not pay taxes on because you're going to offset it with the loss. Versus if you just held on to stock A and it went back, you didn't get anything out of it.
I think people think losses, to your point, first off, they're unavoidable. You are good. If you never have a loss in your portfolio, please come work at Monument. There is a position currently open,
right?
But we will make room for you if there's not a position. If you never have,
no one's coming to work here. If that's the case, they're going to go buy Necker Island and live down there,
right? I mean, I think that's you'd be better than Warren Buffett in a lot of ways. But I think to your point, it's again, I said at the beginning, this is going to be a cliche episode. You're making lemonade out of lemons. Mm-hmm. It sucks to have losses, but you can use them to your benefit, especially when it comes to taxes,
right,
in your portfolio. So take something that's unavoidable and turn it into an asset, really. And I think we talk a lot about, like I said, these losses can add value.
Mm-hmm.
It sucks to have them, but realistically, like they can actually add to your after-tax returns, which we keep talking about, because at the end of the day, it's not how much you made, it's how much you got to take home.
Right.
No one cares what your gross pay is in your paycheck. What a lot of people care about is what is your take-home pay. Stocks the same way. So let's say you had $50,000, you invested in the S&P 500 at the start of 2025.
Right.
So the 31st, basically almost a year ago, we had a great year in the market. Your portfolio is probably up somewhere around, to a value of $58,850 roughly.
I'll take your word for it.
You can trust me.
Okay.
You know what that means is if you sell your portfolio, you're going to have to pay tax on that $8,000 you made.
Right.
Well, if we're talking about it, if you can offset some of that $8,000, let's say during the year, you actually were able to harvest some losses. Now you may only have to pay tax on $4,000 of gains.
Right.
Which again, if we're talking depends on your tax rate, 20%, saving 20% on $4,000, you just made $800 for just being strategic, right? You paid $800 less in taxes because you were able to harvest losses along the way.
Right.
Again, it's an unavoidable thing to have losses in a portfolio, but to sit on your hands and say, "Oh, I'll sell it when it comes back." What are you doing?
I understand that emotionally it satisfies that, well, I held it till it came back, or I didn't take the loss, or I didn't admit defeat, right? Because that's really what it is. It's like, because when people say, "Oh, I'm just going to hold till it comes back," it's like, what makes you think that it's going to come back? We say this all the time. There's no facts about the future. Right? Yeah. So that is such an emotional reaction. And if you just look at it clinically and you say, look, and this is a Marine term, okay, but we say like, you're making chicken salad out of chicken doo-doo. Okay. So, right. I've been asked to clean up my language.
That's fair.
Right. Like my wife's all over me about anyway. So, but that's exactly what you do. So if you can make that trade and you can emotionally get over that hurdle and actually get harvest some good out of the loss, I just think you're in a better spot.
Well, and you briefly touched on it, but I think I don't want to gloss over it. If let's say you don't use those losses to offset gains in a calendar year, you get to roll them forward forever. And so at some point in your life, you're going to have gains again.
Right.
And where this actually adds a lot of value is if you know that you're going to be selling a second house, maybe your business, and you're going to have a large capital gains 5 years out, getting a solution right now that is harvesting losses for you maybe can help that be more efficient when you do have that large capital gain event. Again, you got to turn a loss into an asset.
Right.
And you can do that.
Right.
If you know kind of how to operate and trade around your portfolio.
But let's segue into how we consciously do this. We do
Correct.
On purpose, right? And we have a portfolio, we call it tax rebalance and index optimize, our trio portfolio. And essentially what it's doing is it's investing, and then when it has the opportunity to take losses and harvest it and basically sell Coke and buy Pepsi, I'm just saying same, Lowe's, Home Depot, something like that. It's automatically doing that for you. So the idea of a strategy like our trio strategy is if you can get something close to, if not exactly, the index return. So let's just use last year's example, and I'm going to do some Dave Armstrong rounding here. Okay. Market was up, S&P 500 was up 17% last year. Okay. If you had a portfolio that was just invested in the SPY, the ETF for the S&P 500, you probably had something close to a 17% return, right? Mm-hmm. Some friction in there with some expense ratios, but just set that to the side for a second. Now, if you had a basket, and so that's one ticker. So you can't harvest anything, you own it, and you got 17% in there. But if you own a basket of stocks that replicates that 17% return,
the individual names.
So there's 500-ish. Give me some artistic license here. I know people are screaming. There's more than 500.
The ghosts on the podcast land are like, Dave knows nothing.
Right. Listen, go visit the comment sections for the commentary there. Okay, but let's just say you can replicate the 500 stocks by just owning 300 of them, right? Because it's a market cap.
Sure, yeah.
So you can really kind of. Now, inside those 300 stocks, like you said, there's going to be losers in there. And if you can sell Coke and buy Pepsi, sell Lowe's and buy Home Depot, and still at the end of the year get that 17% return, but then all of a sudden you get this 1099 in the mail, whenever you get those these days, and say, holy cow, I have a loss that I can write off. Where did that come from? Well, you got the 17% return, but the strategy is purposefully harvesting those losses on your behalf, takes all the emotional decision-making out of it. Now that I've talked about it for 5 minutes, why don't we talk about it?
Yeah, right. I mean, I think that's kind of when we talk about how do you build a tax-efficient portfolio, you need to have a strategy that knows what to do with losses. It's as simple as that. And that's what Trio does. And I know Trio, like you mentioned, has the kind of jargony name, but I mean, when I talk about clients, like Trio has 3 purposes. First off, it's a great investment strategy. Again, we're not here to lose money. So you get that index-like return or whatever index you're targeting, whether it's S&P 500, blah, blah, blah.
Right.
So you have great, strong investment process. You got the tax efficiency. So when those losses come up, you are able to sell a position. And sometimes it's not as simple as sell Coke, buy Pepsi. We've done episodes on our Trio strategy. We write about it all the time. But I think for anyone who hasn't, I'm going to save you time of going all the way back, is sometimes if you sell Coke, you might be able to buy 3 other stocks that have no relation to Coke or Pepsi or the beverage industry.
Right.
But when you combine them, they move exactly like what Coke would, right, for risk return. Now, what that does is it gives you 3 more opportunities to tax loss harvest. So some of the pushback people give around direct indexing is, well, why do I own 300 individual stocks? You have a conviction on 300 stocks? No, I don't. All I know is that this portfolio, when you look at it in its entirety, holistically, is going to perform like the index.
Right.
And I have 300 opportunities to be tax efficient. And that's, I think, the real big power of the tax efficiency is it's when you sell something at a loss, you don't want to take that money out of the market. You're not trying to time the market. Right. You need to get immediately reinvested. So when the market recovers, you're right there with it.
And this isn't the greatest example in the world, but it should make sense to everybody. I'm making this up on the fly. But let's just say one of the stocks is trading at a loss as an oil company, right? And you're like, okay, well, I'm going to sell the oil company and buy another oil company. Or I could sell the oil company and buy 3 airline stocks.
Sure.
Because the airlines
the math works.
Right. You know, oil prices drive a lot of earnings in the airline industry. Again, go to the comments section for all the commentary on that comment. But I'm just saying to make the point, you're right. You don't have to replace the oil company with the oil company. You can replace it with something else that acts like the oil company.
Exactly. And I think, again, I said there was 3 reasons. So the last one is customization.
Right.
So around Trio, you get customized. And that means every strategy factors in your specific tax rates and your preferences too. I mean, this episode isn't about ESG investing or screening out stocks that you don't maybe morally agree with. You can do that kind of stuff. Or if you're concentrated in Apple stock because you work there, we can exclude that. But that's not the customization. It's more the customization that feeds into the tax efficiency.
Right.
You know, if you have a lower tax rate, maybe it makes sense to realize some gains from time to time. So 30 years down the road, you haven't compounded that problem. We see that a lot with clients who did the right thing. They stayed invested for the long term, but now they have this huge unrealized gain. And when they need money from the portfolio, big tax bill.
Right.
If you're constantly trying to work that down over time, you have a less tax bill in the future.
Yeah. I'm going to throw out a 4th use case scenario. A lot of times when clients hire Monument, they're coming from somewhere else. So unless our next client is the next Powerball winner and just gets a chunk of cash, right? Chances are
Which, by the way, always take the lump sum. Got to throw that out.
I'm telling you, I was vision boarding winning that thing last time. I'm telling you, like, I was shopping for a Global 6000 on the internet because I was so sure I was going to win. Beat out by some guy in Arkansas or some gal. I don't know, but just saying. I mean, that's a lot of money. It was like $800 million.
It's well, speaking of taxes, right? You don't get to keep all that, but either way, you better know how to use it efficiently.
It's unbelievable. I was doing like some fun math with my wife. I was like, okay, if we won the Powerball after taxes, we could spend $150 million on whatever we want to, invest the rest at 5% and spend $30 million a year and never get below $100 million in our portfolio by the time the second one of us dies. Like, that's... Oh, hi, Elsa.
Hi. She's joining the taxes.
She's loving taxes.
But I think But you would have to do it tax efficiently. I bet you would use a trio kind of strategy,
right?
If you had cash. No,
but here's the other use case, right? So unless you're a Powerball winner and you come in and you say, "Hey, I'm coming in. I have a portfolio that's been managed by somebody, and for whatever reason, they're coming in and hiring Monument." They're going to walk in the door with a portfolio of stocks, bonds, cash. Let's just say, right, and it's going to have cost basis, and so many times, changing an advisor relationship will also prompt changing a portfolio. So you have to artificially pay your taxes just because you're hiring somebody new who's going to manage your portfolio differently.
Yeah.
Okay. Using Trio, we can take an existing portfolio and whittle those taxes down by selling stocks that are trading at a loss and start to whittle down those capital gains so we can convert a client into a new portfolio without massive incurrence of capital gains tax all on day one.
Yeah, which is a huge deal.
Yeah.
I think a lot of people think, oh, well, my advisor does X, Y, and Z, and they get maybe sold a story by a new advisor. Some of them just say, hey, well, you got to pay a ton of taxes if you want to work with me.
Right.
That makes no sense. You should be able to accommodate my situation, my specifics, make it work for me versus, all right, I need to fit into your cookie cutter mold portfolio.
Right.
So, I mean, I think, again, we talk about Trio all the time. I think it's one of the most powerful tools. And Trio I'm using as a synonym for a tax loss harvesting strategy. A strategy that is actively looking for tax loss harvesting and at the same time making sure you're staying invested.
Yeah.
Because the goal isn't to generate losses. At the end of the day, remember all these cliches. There's the biggest one that I have. I don't even really like it, but it's dogs, it's Monument. Elsa made an appearance earlier on the show.
She's way into tax loss harvesting, dude.
Way into it. But it's never let the tax tail wag the investment dog.
Did you hear that, Elsa?
Yep. The tail does not drive the dog drives it.
Right.
And that's where it comes into your portfolio at the end of the day is still an investment. It needs to grow over time. But if you ignore taxes, you could lose out on a decent amount of your returns.
Right.
But be smart. So just be smart. And again, we started this episode by saying it's kind of too late for 2025, but these are what you can do going into 2026 and starting 2026 to make your life better in a year.
Right.
And if you're not listening now, we're going to send this out again just for fun next year, probably.
I think it would be great.
So, but, well, I think we talked enough about taxes. So, at the end of the day, we do appreciate all the listeners. And for anyone who made it this far into our tax episode.
Thank you very much.
Right.
If you made it this far, you got to see Elsa, which is kind of a...
Yeah. And if you're listening only, you should go check out the YouTube channel because, again, we're in the studio. We got Elsa and Lila, who doesn't make camera appearances. She's too zonked out. But
she is definitely zonked out.
It's not Monument unless you got dogs, right?
Exactly. So, well, thanks for making it this far. Just want to remind everybody that in addition to episodes like this, Nate and I do an Ask Monument Anything or an AMA episode, right? So in that episode, we take questions that people have either asked us on the phone, asked us in passing, but we get a lot of questions that come in through either comments in the YouTube section or we get emails. And so if you want to email a question for us to answer, which we just did the other day, we had some fun with it, but we get questions, we will answer them. You can drop us an email at offthewall@monumentwm.com. So that's all one word, right? offthewall@monumentwm.com. You'll come in, we will throw it into a future episode of AMA, and we will knock out an answer. And you never know what you're going to get out of an answer from us. So
that's why I like those episodes, right? Like we just log in and basically say, okay, these are the questions. What do we think?
Right.
So it's a lot of fun. And if you're enjoying this show, we always like to promote kind of our sister podcast, Between Sips. Emily, Jessica host that one, talk a lot about the financial planning topics, how to really put purpose behind your wealth. I know we do a lot of investing here, but...
Well, this is our thing, though.
Correct. I mean, they have their thing.
They have and I like to joke, they don't let me on their thing. I'm not allowed on their podcast.
I feel like I've heard that before.
I'm not bitter. I'm just saying.
No. And by subscribing to both, all new episodes right at the top of the feed, we're constantly putting them out, so you never have to look for them.
Right. So... Well, thanks a lot for tuning into this episode of Off the Wall, and had a great time with you, Nate. And you'll notice I've got the Madonna album up here this time. Last time it was Pink Floyd, The Wall. So we may just keep swapping some records out here and see who picks up on what we've got next. And Nate, who do you got back there?
I've been Bob Marley for a little bit. We might keep it up. He's always
cool.
It just feels like we all need a little bit of love.
I know.
Let me say it that way.
I know. So, all right. Well, with that, we'll see everybody on our next episode of Off the Wall.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.